Hey everyone, thanks for joining the FBA podcast. My name is Henson from FeedbackWhiz, and our guest today is Ken Kubec. And Ken is the VP of Acquisitions at Thrash.io. Thrasio is one of the fastest growing companies that acquires Amazon FBA businesses. They're fully funded by many top investors, and they'll pay cash and ensure a 45-day close. Check out their website over at thrash.io. That's THRAS.io. Thanks for joining us today, Ken. So for all the Amazon FBA business, FBA brand sellers listening today, Ken's going to go over exactly what you should do to get your brand set up for an acquisition. And any of the new sellers who are looking into getting into Amazon, Ken will discuss on how to properly set up your company brand. So thanks, Ken, for joining our podcast. And if you could give us a little bit of background, what'd you do before you got into Amazon?
Yeah, absolutely. Thanks for having me on the podcast. It was great spending some time together at IRC over the past week, getting to know some of the team, including the Wiz.
Yeah, that was fun.
Yeah, it was fun. Just my background. So I had spent, previous to entering the Amazon ecosystem, I had spent 13 years as an investment equities analyst and portfolio manager, investing in small cap technology growth stocks. So worked at some of the largest mutual fund managers, managing a couple $100 million across multiple mutual funds. And then I just got kind of burnt out of the Wall Street grind, and actually connected with an entrepreneur in Boston that had a few different businesses, one of which was a $15 million a year Amazon business. He had a couple other businesses he was working on and needed somebody to come in and streamline operations and operate the day-to-day for his Amazon FBA business. So it was something totally new to me. I love learning about new things. I was always enamored with Amazon as a consumer, so it was a great opportunity to join and learn, look under the hood and see how the marketplace and ecosystem actually works from the inside. So I did that for about 2 years, really learned a lot, learned about all the trials and tribulations of being an Amazon seller. And that basically put me in a great position to run in my current position as VP of Acquisitions at Thrasio, kind of basically marrying my investment background and then also my Amazon operational background. So Thrasio was started, first acquisition was done over probably a year ago. We just had our anniversary, I think, at the end of May. And then, conceptually the company was conceived, I would say 2 to 3 years ago. And it took a while for the owners to, just kind of come together. They were both running previous businesses, were in the process of starting to exit, et cetera. And, so then they were originally going to do an e-commerce roll up. So they were going to, financing and SEO are two of the, basically strong attributes of, both owners. So they were going to roll up e-com sites, leverage SEO. And then the more and more they learned about Amazon and the scale of the FBA platform, they thought it was a great idea to just, try an acquisition there and see how hard it is to operate, an FBA business. Turns out it's not as easy as people think it is from the onset, right? You hear these stories of 4-hour work week and, work 5 hours a week and you can, become a multimillionaire. I think that's true in some cases, but, the real successful businesses we've seen are the business owners who actually treat this like a business, not a side hustle. So with that, they decided in earnest to build out a team and really focus on strong operators with experience that supersede where the company was currently at, but focused on where it can be over the next few years. So fast forward to today, we've acquired close to almost 20 brands. We have a team of almost 50 people, and the pace right now, we're acquiring 2 to 3 Amazon FBA brands a month.
Wow, that's a really cool story and how you started, and how fast you guys grown with the 50-person team.
Yeah.
I guess my first question for you really is, as a new seller looking to start on Amazon, what do they need to do to set up their business properly. Even for the existing sellers, like if they, everyone's goal is to try to get an exit at some point, right? So
Yep.
what are some tips or what they should need to do for you guys to look into and say, hey, this is a legit company for us to invest in?
Yeah. So, I think if you look, we'll probably talk about this, towards the end in terms of the future of Amazon. But, one of the things that is a requirement is having your brand trademarked. So I think a lot of people, that might be an afterthought when you get started, right? It's just, hey, let's just come up with a brand that's not taken in the storefront and, build a product underneath that moniker. But with brand registry 2.0 and what we believe is going to be increased scrutiny on sellers and IP, we think that's just table stakes. So if you don't have your brand trademarked, I would definitely, do that tomorrow. The next thing is just the, legal structure set up. We've bought businesses that were domiciled in the UK, Philippines, Romania, US. Just make sure you have, a clear ownership structure in place. I would advise you to either, talk to an accountant or someone else that has knowledge on tax implications on the sale. There's just varying tax codes and pros and cons of where your business is domiciled. So, set that up. The other thing that I, as somebody who's upfront talking with sellers, looking at their business, looking at their profit and loss statement, having your accounting basically, at least have a monthly P&L that you're keeping track of. There's two types of accounting: cash-based and accrual-based accounting. Most sellers, will have cash-based, which is basically just money in, money out. So if you buy your inventory in June and then you sell it through in the subsequent, 6 months, you're going to lose a lot of money in June, but you're going to make a lot of money in the subsequent 6 months. What buyers like to see is what's called accrual-based, and that's where you matching cost for each revenue dollar associated with that. So, if you basically put the inventory on your balance sheet and then it goes through your P&L for every unit you sell, you have a true, it flows through on the cost of goods sold, and you actually have a true profit and loss statement where you can see the underlying true economics of the business. So I think those are like the three, I would say, table stakes. And then, what we look for is we look for leaders in their markets. So, we don't want to be, buying products that are just me too, that, maybe are on page 2, page 3, kind of lost in the Amazon endless aisle.
Mm-hmm.
So, I would recommend that people really focus on their hero SKU to start. So all your marketing, all your, if you only have money to shoot a video for one product, or optimize or design, etc., I would really focus on one product, nail that product down, do really well, beat out your competitors across the visual representation of that product on Amazon. And then I would start, once you get that going, I would start to then diversify. But until you really nail that hero product, I wouldn't diversify too far away from, I wouldn't go from one product to 10 products just because you think that's what a potential buyer would like, that diversification. Mm-hmm. Oftentimes we call it diversification. You only have so much capital to allocate as an entrepreneur, and if you're earning a lower and lower return with each incremental dollar capital that you're investing in your business, that's just not a good business.
I see. So basically your advice is, have one, you guys are looking for like a brand with at least one solid product, and not so much like a whole bunch of products that are like mediocre and like page 2 or 3, because it's not that attractive, right? So.
Right. Yeah. And it could, could easily fall away, or, become less and less competitive over time. Mm-hmm. We think that we look for products that are in, everyday demand products that have evergreen opportunities. So think of hard goods, think of, umbrellas, and just, our ideal company is the number one selling spatula on Amazon, right? Yeah. No one's really going to innovate the spatula. The buyer psychology is based on social proof for that category, which is effectively price, review, quantity, and review score. And then, if all those things are somewhat equal, the next, is going to be the eye test in terms of content and what the listing looks like, etc. So we're basically trying to buy that leadership in social proof, and we think over time that will have a defensibility of the revenue and cash flows for that business.
Gotcha. So I guess another question is, you guys are more focused on Amazon businesses, but let's say I had a business that sells on Amazon. I have my own website, might have a Shopify store. Do you guys buy the entire brand, or is it just the Amazon part of the business? Like, how do you guys?
Yeah. Yep. So most of our purchases, unless you're domiciled in the UK, are structured as asset purchases. So we buy everything associated with that asset. So it'd be the trademark, it'd be the Amazon or the Seller Central account, all your websites, your Shopify websites, etc. Most of the businesses we do buy have their own D2C presence, mostly on Shopify or WooCommerce platforms, and we think it's a great asset in terms of highlighting the value proposition of your products better than you can on Amazon. I would say 50-50 people are having it linked back to their Amazon listings versus fulfilling directly through a 3PL. I would say the majority of the brands that we purchase, though, are 90+% of revenue is coming from Amazon. It's a different business model. If you're going D2C, customer acquisition costs are wildly different and more expensive than Amazon. And it's just, you do have to manage a 3PL. You have to manage content production. You got to, advertise on Google, Facebook, Instagram, etc. It's definitely an expertise that we're building out in the team, and we think that's kind of version 2.0 for a lot of the brands we're acquiring, is to take them off of Amazon. Mm-hmm. But we think there's so much leverage and opportunity left in Amazon itself. Let alone the U.S., but even when it starts to get really exciting when you look at what inning the other geographies and marketplaces are in within Amazon.
Gotcha. So let's say you guys found a potential client or business that you guys are interested in. Like, what kind of metrics do you guys look for? Like, what's your say like valuation metrics, like seller discretionary earnings? Like, what is the cost? How do you determine, how much this company is worth and making it off?
So for us, kind of higher level is our ideal kind of acquisition targets are, doing 1 to 10 million, probably even higher. And now at this point that we're of larger scale, we were a little bit leery of concentration risk when we first started making acquisitions, but now we have a much broader revenue base. So I'd say it's probably that high end has drifted probably to 15 million in revenue. So 1 to 15 million in revenue. And then every business is different. I would say the average margin structure that we've seen, I've looked at probably 250 plus P&Ls, since I started. Mm-hmm. And I would say the average kind of net margin is probably 20%, but we've seen some as high as 35%, and we've looked at businesses as low as 10%. It really depends on the space they're in. If they were an early leader, they built maybe they were really early, so they had tremendous pricing power. But they're still the leader, but they've had competition come in. But it's still such a high volume space that we would love that business. One business, for instance, we looked at was doing, I think they were close to 7 million a year in revenue. Almost 5 million was from one product listing, right? And their net margins were probably 10 to 12%. Now for that, we might look at price and say, hey, if FBA fees really go up over the next few years, what's our risk profile, right? You just have a much lower dollar volume to absorb, less margin to play with. But I would say, as long as you're around in that area, I would say 15 to 25% of net margin is the majority of the businesses we look at. Really high margins, might mean you're susceptible to incremental competition over time. So then it becomes how much of a lead do you have in that market, right?
Right.
And that's why low margins could be, a defensibility, right? It's, hey, it's really expensive to operate in this market, so that's actually could be a competitive advantage where, someone's not just going to source up Alibaba and, spend a lot. It's going to take a lot of money to enter the market, right?
Right, exactly.
Yeah, and then I would say overall revenue growth profiles, we've seen it vary. I mentioned kind of the 200 plus P&Ls I've looked at. I basically did a revenue study, and there's just a clear revenue trends for when FBA businesses hit escape velocity. So first, I would say 6 months. Let's say, so for a company that eclipses $1 million in revenue, this has been the typical profile has been the first 6 months. It's like 50 to 150,000 in revenue. The product takes off. They're chasing inventory, and they get their legs underneath them on the inventory front, and then they got to try and find financing. So that 50 to 150,000 jumps to anywhere from 4 to 500,000 first full year in operation, and then it steps up to $1 million to 1.2 million, and then you actually, oftentimes we'll see, a doubling of revenue from there, and then it starts to plateau a little bit at 3.5 to 4.5 million, unless they have a lot of products that they're ramping underneath the engine, so to speak. So it depends on, just where they're at in their company life cycle for revenue growth. So we don't explicitly say, hey, we only want to buy businesses that are growing 50%. We've bought businesses that have started to decelerate, that have just hit peak, and we thought we could optimize them on, some of the costs and re-accelerate growth with PPC investment. So there's no real outlier. I think the only really disqualifiers that we have from an acquisition standpoint are, we don't like to take on a lot of heavy technological obsolescence risk. We don't really purchase anything that has a high fashion component to it, and no fads. So, we're not going to buy
no fidget spinners.
No fidget spinners. Yeah.
No.
I mean, it's a loose definition of what a fad is, but I think we all know one when we see one.
Yeah.
Yeah.
Exactly. So I guess maybe that's some really good information. So let's just throw out some numbers here. Like, let's say making $1 million a year, right? And then after profits and everything, let's say I was $200,000, right?
Yep.
And add in the owner compensation, maybe another 100K, so 300K, right? So what is the normal like valuation multiplier you guys see? Like, what's the range? Like, is it like 1x, like 5x?
Yeah. So I mean, I know there's varying arguments in the marketplace around this. Our stance is the market is the market, right? Like I said, my investment background, when I was investing in stocks, I'd say, this company's worth $50. Why is the stock trading at 30? Because that's what the market is pricing the asset at. So, that's what is changing hands. So you have a buyer and a seller, and they're meeting in the middle, and they're agreeing to sell at this price, and they're agreeing to buy it at sell at X, and someone's agreeing to buy at Y. So I'll tell you from our experience being in the market, conducting almost 20 of these transactions, really in earnest over the past 6 months, the market is anywhere from 2 to like 2.5, 2.75 times for your average Amazon FBA business that's doing around the numbers that you spoke of. Now, there's going to be people out there that have a tremendous business, and maybe they're growing 150%. They have super high margins. They've created a niche in the marketplace. They have tremendous outside Amazon exposure, and they're actually building brand equity. Those businesses might get 3 to 3.5 times. That's kind of the range that we've paid. The median multiple has been around 2.2 times. Now, we're willing to align with owners and give additional compensation on top of that multiple. So we might structure a lot of the deals we structure have an earnout component to it, which might bring the total transaction value to 3 times or 3.5 times trailing 12 months. So seller's discretionary earning that you alluded to. But it's really, each deal is different.
Right,
kind of, it really goes back to all the factors I mentioned before: growth profile, margin, positioning,
So would you say like bigger businesses are probably worth more money just because, it's a more stable structure, they've been more established rather than someone that just started making, let's just say I just started selling a brand new product. It's attractive to you guys, but I only have 1 year of history and I'm making 5 million, but it might be
Yeah.
risky because you don't know down the line, maybe they don't have the same setup as, a more established company that's been around for, let's say, like 5 years and they're doing like, 50 million, right?
Yeah, and so for bigger businesses, I think you have a few dynamics at play. One of this, which you mentioned, just the stability and the comfort of the underlying cash flows that the business and the brand are producing. The other big component is that you're going to have more competition for the asset, right? So if you are doing, let's say, I would say the cutoff's probably 3 million or more in sellers' discretionary earnings, then you might actually get private equity firms that are kind of coming down market and looking at deals those size. So they're going to be willing to probably pay a little bit more for those businesses themselves, and because they might be one-off purchases or they really think that they can take it off of Amazon. But from what we've seen for Amazon-specific businesses, that's the range. And I think you also have a component of so SBA eligible businesses, which you'll see if a lot of the website brokers they'll advertise, oh, this is SBA eligible. So SBA eligible purchases go up to a total transaction value of $5 million. So you might get somebody who was a sales executive at a big software company, and they want to roll the dice at being an entrepreneur in e-commerce. So they might come in and they might pay 3 times, 3.5 times because they have they're financing it. It's not cash out of pocket right up front. So they might have a higher risk tolerance and be willing to take a look at it. So I think you see, there's a lot of studies out there through various brokers, and I would just caution people that that's just what the listing price is. That doesn't mean that's what the actual deal gets consummated at. I think it's a very similar market to the real estate market. There's a listing price, and somebody might find the perfect house and they're willing to pay over market for it. And then there's other homes that might sit on the market for a few months, and then the seller either takes it off market or they decide they just want to move on and accept a below quoted price. But I think it's just important that the market's the market. We're not going to be the buyer for everybody. We're not going to, there's deals we've lost a price. So we're disciplined and we're comfortable. And, I think hats off to people that get higher multiples. It's a marketplace.
Yeah. So you were talking about brokers. Usually sellers right now, they will find a broker, and most brokers take around 10% of, whether the sale price is. But with you guys, there's no broker, right? Because it's just straight from seller, right? So
I mean, brokers are they're great. I mean, we've done multiple transactions with all the big brokers: Quiet Light, Website Closers, Empire Flippers. I think they do a great service for the ecosystem, right? They help educate the sellers on what the process is like. They can be there for support, emotionally, or just, hey, am I making the right decision? Just kind of holding their hand through the process. But you're right. If they do work with a broker, they are going to pay that broker fee. But they do a lot of legwork that kind of warrants the fee, right? They put a big prospectus together. They make sure your financials are in order, et cetera. We've kind of, I guess, a little bit reverse engineer that, where we basically have that own service in house. So we're able to create a P&L. Given Seller Central access with basically an hour, we can provide produce a monthly P&L as long as we get kind of loose COGS data. We have a team that does all the competitive analysis, and we know how to look at Amazon businesses and marketplaces. So, but you're right. Yeah, if they just come to us direct, you kind of lose that broker fee. you get to keep that in your pocket. And we can also, we have a bunch of referral partners on the legal side and things as well that we can point people to. But some people like the comfort of, they don't want them to negotiate directly themselves. Again, just like kind of selling a house, you could
middleman,
self-list
like
it.
an agent, and
Yeah,
we can help you
yeah,
negotiate or
You're not
just look
exactly.
at your back, right? Because I mean, as a buyer, you might not know, all the financial part of selling a business, so you might need an expert to help you out.
Yep. Yeah.
So let's say you guys find a business, you make an offer, right? And I'm the seller, and I'm saying, hey, I like the price. Like, what's the next step after that? Like, what's the process?
Yeah.
Getting this deal done or closed.
Yep. So the first step is negotiating on just high level terms. Solidified. We basically both parties sign what's called a letter of intent or an LOI, and kind of the acronym. So once the LOI is signed, that's when we our diligence team. We have a great deal team, the majority of whom are in New York. They kind of kick into high gear and work one-on-one with the sellers or the seller/broker on just getting access to Seller Central if we don't already have it, reconciling financial statements, looking at supplier contracts, looking at patents, verifying trademarks, so kind of all the things that if you were buying a business, you'd want to check the boxes basically. But the beauty of Amazon is you have a canonical source of data, which is Seller Central, right? Like the numbers are the numbers. There's not much, fudging that can be done except on the general and administrative costs of running a business. So, we get access to bank accounts, et cetera. And that process, usually we ballpark it to take 30 days. We're working on a deal now that might get done in as little as 10 days. It really depends on the complexity of the business. But we have a team that is able to do 3 to 4 a month right now. So as long as we stay in that pace, that should be the time frame. And then let's say at the end of that 30 days, we formalize a legal binding contract, which is the asset purchase agreement. So up to that stage, there's really no legally binding. It just gives us an exclusivity to look at the company, and then also it's a non-disclosure, et cetera. And it just says, hey, if these are the numbers that turn out to be what they said they are in terms of the profits of the business, this is the executed deal price. And then the asset purchase agreement is the actual execution of the deal. So, basically the way to think about it is sign a letter of intent, 30 days later, whatever the purchase price is, the agreed upon upfront guaranteed cash portion gets paid out once the APA is signed. So that's 30 days, you kind of get your biggest chunk of money. And then there's another, it depends on, again, the business, but probably another 15, 20 or 30-day migration period whereby, we take on the Seller Central account, we start to migrate the inventory, start ordering new inventory. And there's a little bit of hand-holding from the owner in that portion. And then I think one of the things that really differentiates Thrasio as a buyer is that we have our own operations, team in-house, our own experts. So once that migration period is over, there's really no, ask from the seller to stay on and consult. So oftentimes, I see a lot of prospectuses and the seller says, oh, we're willing to stay on for 6 months and dedicate 15 hours a week to help transition. We don't require any of that. So I think it's a great opportunity when you think of time value of money for somebody to, sell their business, basically get paid within 30 days, 45 days. That allows them to go on and have the funds to either start their new endeavor or, go into something totally different.
Yeah, that's great. I guess another question for you is, I'm sure you guys done a lot of transactions where, somewhere in this process, maybe the deal falls apart. You guys find something you see something you don't like, maybe a red flag. Like, could you explain maybe, some of the things that could possibly go wrong or you might find before you get to the asset purchase agreement?
Yeah. So we don't enter a letter of intent without the explicit expectation that we're going to close. So we close 95% of letters of intents move through to final purchase. So there's a traditional private equities. Some private equity models is like get them under agreement and then beat them up on price as you go along. We know there's going to be just things that are not completely tightened up, or exposures, or that we're going to inherit. This is the marketplace that we've chosen to make acquisitions in, so we know there's inherent risk with them, right? So a lot of that is, to be candid, reflected in the prices, right? But also, we'll either try and ring fence it. For instance, we had one product that there was definitely some product liabilities associated with it. There was a class action lawsuit. We were actually able to carve out those specific ASINs from the entire purchase to still get a deal done. We left those ASINs with the seller and said, hey, we'll license you back the trademark. You can continue to try and, basically resurrect that product. The product score started to really plummet. And then we just had this outstanding liability that we couldn't really put a dollar value around. But for the most part, if there's something that's dramatic that comes up, we're easy to work with. We want to do a deal, and consummate the deal. So we'll work with the seller, and, very rarely, unless the profit number's off dramatically and there's no explanation besides it was just falsified up front, or they didn't, account for these costs, etc. Very rarely do we, if it's in a certain range, we'll still do the deal. And there were even, there were a few deals where, it came out, they've been like illegally eliciting reviews, call it, something kind of that I'm
Black
sure you
hat
see all the
stuff,
time
right?
on, black hat stuff, right?
Yeah.
The only time if they're not open with it, that's when it becomes an issue. But if they're open with it, we'll just say, okay, like, well, how many reviews do you think are at risk of being scraped, right?
Right.
And then maybe we do a little bit of a holdback monetary value in case those reviews get scraped, because that will impact the algorithm and placement, right? But we've structured deals like that where something has come up in the nth hour, but we still have worked with the sellers to get deals done that was equitable for both parties.
Yeah, that's great. That was really good information. I think pretty much covered the whole process of, getting your businesses set up, ready to sell, and then the entire going through before you get the, sign off on the deal.
Yeah.
Maybe ask you a question that's kind of a little off topic, but still related to Amazon. Like, what do you think about the new tariffs right now that are in place for the Trump tariffs? Like, how do you see that affecting, either the way that you guys evaluate businesses, and as a seller moving forward, like what are some of the impacts?
Yeah, I mean, so the way we look at it, right, is on average is another benchmark. COGS is probably cost of goods sold is typically around low 20% range as a percentage of revenue for your typical private label FBA brand. So if you think about that, right, like let's say your cost goes up by 20%, right? So you're looking at like maybe a couple hundred basis points or points of margin on overall net margins. We think people will offset with prices. People will find other ways to offset the total margin hit. We don't think it's a long-term headwind. One of our, I think, strong suits is our supply chain. So if you think about how complex our supply chain is, with every acquisition we do, we're often taking on multiple supply chain supplier relationships. 3PL, multiple 3PL. So from our perspective, we're eventually we'll start to consolidate a lot of our own supply chain. So we think we'll be able to offset some of the savings. Agreement whereby, hey, if you get hit with tariffs, we're going to reduce price, or clawback or anything like that. We're going into every deal eyes wide open. And we look and say, hey, if prices, we just do a scenario analysis. If prices do rise, what does that look like to us? But we never put that theoretical into any sort of deal structure.
Gotcha. So what do you think about Amazon and e-commerce in the next, foreseeable future, like 5 years or so? You think Amazon?
Yeah, I mean, I extremely excited and bullish. I think it's easy when you live in this ecosystem to get negative and worrisome. I think, the get rich quick portion of Amazon, right, is probably in the sixth or seventh inning relative to 2013, 2014, 2015. But I think for the people that have built really good businesses and have the product scores, the review moat. I think it's increasingly becoming actually a more favorable marketplace. Because conversely, it's much harder to launch products, right? So the value of your existing products should start to increase over time as Amazon cleans up the bad actors and the bad tactics, etc. And when you look at e-commerce overall, it's still anywhere from 12 to 15% of total retail sales, with Amazon attributing half of that. So I think when you look at shopper behaviors, demographic tailwinds, and just the endless aisle that Amazon offers, I think we wouldn't be doing this if we thought there was a big, we're running full steam into a concrete wall in 3 or 4 years. So I think I often get asked that, and I debate it. I had a few debates at IRCE about Amazon and, are they going to who they going to lose to, et cetera. At this point in time, I really find it a hard, an answer for a competitor who's going to come in and usurp Amazon's e-com dominance. I think it would have to be somebody that has, I guess, the biggest, blind spot that Amazon has is surfacing new brands and new products to market. Right? I mean, there's only so much space on page one to advertise products. They're trying to answer with sponsored products and headline ads and things like that, and the accelerators and incubators. But that's where some platforms like Instagram and Facebook, I think, have a leg up in product discovery. So I think that's a gap that Amazon is trying to jump. But in terms of, I don't think anybody's going to beat them on delivery, breadth of product offering, and price. Right? Maybe price, but the price is set by the marketplace and the suppliers on the market, right? So I think, we look at it all the time. Hey, should we be taking this product in the Walmart.com? Should we, Jet? Should we be doing Shopify? I mean, when you look at it on a financial basis, it's really hard to justify the return at this point. Which
I mean, just based on just the domination of how much everyone uses Amazon, right? Everyone buys on Amazon, and it's just they've made the process really easy, right? Where I don't need to go to the store, drive my car, I get my stuff the same day now, right? And back in the days, I used to spend a lot of time like going through like eBay and looking at like what's the best price for the same product, and spending a lot of time looking for the best price. Now it's like, hey, I just want something at Amazon. If I see on page one, it's great. I don't really care too much about the price. I'm just going to buy it, right? It just makes my life easier, right? And it's hard to see a platform that just comes out and it can make the same type of experience. But definitely,
and it's going to show up on time. It's going to show up on time, right? I mean, that's I think the beauty of the FBA model is just you're riding on Amazon's brand, right? I mean, everybody knows Amazon, everybody shops on Amazon, right? So you're leveraging their brand, and you don't necessarily have to spend a lot of money building brand equity, and that's why you're paying a 15% commission, right? You're paying for the traffic versus a direct to consumer brand, which you're investing, you're definitely running at a loss for a long time until you really build up that repeat customer base, your lifetime value of a customer.
Yeah, absolutely. Well, I think we'll end the podcast here. Well, thank you so much, Ken, for coming on and giving us so much knowledge about, how to how to set up your company and get ready for sale. I think this is something that's very unique what you're doing. There's not too many other companies right now in this marketplace, and it gives sellers something to look for, right? Something like hope, right? It's like as a seller,
Yeah.
like the thing you really want to do is you want to build a good brand and then profit on it, make some money and cash out, right? So this is really good
Yeah.
now. So for everyone,
Yeah, and I would just say that's a really good point that we didn't actually touch on. Is that just really quickly is just the economics, right? A lot of people say, hey, well, I could just if you're going to pay me 2.5 times SDE, I'll just run it for 2.5 years and I'll make the same money back. And when you factor in taxes, investment, and inventory, you sell your business in the U.S., it's going to be a 20% capital gains tax versus continuing to run it, ordinary income tax close to 50%, depending on your state, and then you're reinvesting that profit back in inventory, so you got capital tied up. So, it's a different economic trade-off analysis than people make it out to seem. So I just implore people to think through it or talk through it with somebody.
yeah, I
If
mean,
that's
it
a barrier.
sounds very complicated, right? Like a lot of sellers are like terrified, like they don't understand, the sales part of selling a company, and just the way that you guys done it make it so easy. I think a lot of people are going to look into like growing their business and selling it. So for everyone
Yep.
out there, again, Ken, he's from Thrasio. That's their website is thras.io.
Please subscribe to our YouTube channel, and for more information, please visit feedbackwhiz.com.